All right, welcome to the Explainer. Today, we're getting into a really powerful chart pattern, the volatility contraction pattern, or VCP. But here's the thing, we're not just going to look at the lines on the chart. We're going to dive into the part that's honestly way more important, the psychology behind it all. So let me ask you something, and this might hit a little close to home. You've spent hours studying, right? You can spot a VCP from a mile away, you know all the technicals, but for some reason your account balance just doesn't show it. What's going on? Why is there this huge gap between knowing the pattern and actually making real, consistent money from it? Well, the answer really boils down to this one number, 90%. So what in the world is that 90% about? It's what the pros, the real pros, will tell you is the single biggest piece of the puzzle. The vast, vast majority of success in trading, it's not about being the best pattern spotter. It's about having the mental discipline, that mental fortress, to actually follow your plan. It's a game played almost entirely right up here in your head. And this quote right here, this is the heart of what we're talking about today. It kind of flips everything we think we know on its head. Seeing the pattern? That's only about 10% of it. That just gets you in the door. The other 90%, the part that actually matters, is the mental game. It's the discipline to wait for the really good setups and not just jump at everything. This is that 90-10 rule that separates the amateurs from the pros. Okay, so if psychology is the main event, where do we usually trip up? You know, it often comes down to just a few key mental mistakes. So let's break down the 4 most common psychological traps that can take a perfect VCP setup and, well, turn it into a loss. All right, trap number 1. This is a classic. It's called pattern recognition bias. Basically, our brain starts seeing what it wants to see. You're eager to make a trade, so suddenly you're seeing VCPs everywhere, even on charts where they, don't really fit the rules. And this is where that discipline really has to kick in. Look, it's so easy to see a little 2-week wiggle on a chart and convince yourself, yep, that's a VCP, just because you want some action. But the professional solution, it's to take your own bias right out of the equation. You have a strict, non-negotiable rule, a minimum of 6 weeks for a consolidation, period. And you have a volume checklist you use every single time. These rules are there to protect you from yourself. Oh yeah. Trap number 2, volume confirmation anxiety. You know what this really is? It's FOMO, the fear of missing out. It's that feeling that gets you. You see the price start to tick up and this anxiety just floods in. And what do? You jump the gun. You get into the trade before you have the single most important piece of evidence, that huge surge in volume that tells you the move is for real. So how do the pros deal with this? Look, they don't try to just magically get rid of FOMO. Nobody can. Instead, they manage it with a system. They might buy a really small pilot position as the price starts moving, just to kind of scratch that itch. But, and this is the key, they only commit their full position size after that big confirmatory volume comes in. It's a disciplined 2-step entry. Simple as that. Now, trap number 3 is kind of the opposite of FOMO, but it can be just as deadly. It's contraction, patience, failure. See, the really high-quality VCPs, they take time, a lot of time. We're talking weeks, maybe even months. And that quiet, sideways chop, it gets boring. And that's when traders lose their conviction, they lose their patience, and they bail. And this shows a massive difference between just waiting around and what professionals do, which is active monitoring. The mistake is getting bored and just walking away from a great setup. The pro, on the other hand, uses that quiet time. They're doing weekly check-ins, rescoring the pattern's quality, basically reinforcing their plan. They are building their conviction while everyone else is getting impatient. Okay, now for trap number 4. And honestly, this is probably the most dangerous one of them all. False breakout revenge trading. You know the scenario. A trade breaks out, you get in, and then, bam, it reverses and hits your stop loss. That emotional sting is real, and it leads to one of the biggest account killers there is, revenge trading. So what's the professional solution here? It's not some complex indicator. It's a dead simple, hard rule. You get stopped out of a VCP, you're forbidden from touching that stock for 3 full days. That's it. This mandatory cooling off period forces the emotion to just drain away. It stops one small acceptable loss from turning into a string of catastrophic, impulsive mistakes. All right, so we've spent some time diagnosing all the problems, all the ways our psychology can trip us up. Now let's get to the good stuff, the solutions. How do professionals actually turn all this theory into practice? Well, they build systematic toolkits that enforce discipline and pretty much take emotion right out of the driver's seat. It all starts with something like a journal. But hold on, look closer at what's being tracked here. It's not just the technical stuff like a pattern quality score. The absolute game changer is tracking your emotional state at the moment you enter a trade. I mean, the simple act of having to write down FOMO or anxious forces you to be objective. You start to see your own damaging patterns, not just the ones on the chart. Next up is how pros tie their risk directly to the quality of the pattern. They don't just decide how much to bet based on how excited they feel. No way. They use a predefined framework. You see a textbook A+ quality VCP, that gets the biggest chunk of capital. A more marginal, so-so setup, it gets the smallest. The rules decide the risk, not your gut feeling. Okay, theory is great and all, but let's see how these frameworks actually hold up in the real world. We're going to walk through a couple of real trade examples that show exactly how focusing on the process can lead to profit. So let's take a look at this trade in Bajaj Finance. It formed this beautiful pattern over 12 long weeks. But notice that crucial part in the middle, the psychology test between weeks 8 and 10. There were a couple of small, failed moves that were just enough to shake out the majority of traders. See, that consolidation wasn't just a pattern forming on a chart. It was a test of discipline. And the reward for the people who passed that test and held on? A clean breakout on huge volume and a 35% gain. All right, now let's dig into the nitty-gritty of risk management with this Titan company example. And the key thing to get here is that the most important work happens before you even think about clicking the buy button. It's all about defining your exact risk in cold, hard numbers ahead of time. So this is what that pre-trade process actually looks like. Step 1, you judge the pattern's quality, and that tells you your position size. So let's say it's a high-quality setup, that's 4% of the portfolio. Step 2, you calculate the exact rupee amount you stand to lose per share if you're wrong. And step 3, that's the easy part. You just execute the plan. All the hard thinking, it's already done. And the results of all that disciplined, process-driven work? A 28% gain. But see, that win wasn't just luck. It was the predictable outcome of following a well-executed professional risk management plan. And all of this really brings us to the final and maybe the most important mental shift a trader has to make. It's about completely changing how you define what success and failure even mean in this game. Just let this one sink in for a second. A perfectly executed trade that hits its stop loss is a success. A sloppy entry that gets lucky is a failure. Think about that. A trade where you followed every single one of your rules, your entry, your sizing, your stop, is a win, even if you lost a little money. Why? Because you reinforced good habits. And that sloppy trade that accidentally worked out, that's a failure because it taught you a bad lesson that is eventually going to come back and bite you. So we'll leave you with this one question to take with you. The next time you close out a trade, don't just glance at the P&L. Ask yourself, did I execute my process perfectly? Because the moment you start judging your process, and not just your profits, well, that's the moment you're truly on the path to becoming a professional.